Afternoon, everyone, and thanks for being here at the Pinnacle event, spending some of your precious time to hear from the stable of managers at Pinnacle. My name is Graham Hay. I'm a Deputy Portfolio Manager with Antipodes. We just celebrated our third anniversary, a team of 20 investment professionals in Sydney and London. We manage 3 strategies, 2 global strategies and an Asian strategy, and we have the ability to be both long, short, as well as actively managed currency. So a reasonably complete toolkit to navigate our way through global investment markets. So the title of the presentation today, and I have 12 minutes to deliver it, is The End of Goldilocks, ? You know, the statement is sort of self-evident. It describes the backdrop of global financial markets over the last 8 to 10 years. Not too hot, not too cold. It's been a perfect environment to be long risk. It's been the goal of central banks as they embarked on the repair program back in 2012-13, and it's worked a treat. The question is, what does the next 5 years look like? A bit of fun with this chart. It's taken from The Economist. It's the low interest rate party bus. It's been a great bus to be on. Who wouldn't want to have been on this bus over the last several years? It has an interesting cast of characters, the likes of Janet Yellen at the back, Larry Fink, the CEO of BlackRock, a cast of various high yield and ETF managers who are on their way to the impending cliff with an almost inevitable consequence. If we take a look at the more academic view of low interest rates, though, you can see that declining interest rates have been a feature of markets for almost a generation now. Some of the previous speakers touched on this. And you can see the blue line there being the US long bond yield has reached generational low levels over the last several years, brought about by the trends of global disinflation. We've seen an accommodative central bank policy have really sponsored that move in rates. Corporate profits we put up there as well seemingly have levitated to structurally a new high plateau, similarly taking advantage of global disinflationary trends, the opening up of the global emerging market labour pool, technology advantages and what have you have really assisted particularly US corporates in carving out a much larger share of global GDP than they had in prior generations. And it's interesting to reflect on that fact as it's contributed to the rise in global populism over the last 5 years or so in various parts of the world. Part of the reason populism has come up is because of that disenfranchisement of labour from its traditional role in the economy. So something to think about, not the topic of discussion today, but certainly we think of note. If you turn to the next slide, you can see some of the things that we've been talking about in terms of interest rates and central bank sponsorship since the GFC. The chart you're looking at here is a time series of the effects of central bank intervention into global financial markets. So you're looking at here is the purchase programs on a rolling 3-month basis of central banks of government paper. And you can see highlighted by 3 significant events: the GFC back in 2009, what subsequently followed that was the European sovereign debt crisis in 2012, and that led up to Brexit in 2016. But you've had this unprecedented sponsorship by central banks in order to head off the worst effects of the GFC and the other mini crisis that the world was staring at in the previous 5 years or so. And the point of today's discussion for us, if there's one message to leave you with, is we're now entering a period in 2018 where that coordinated intervention by central banks is now starting to turn into a tightening mechanism. We are moving from a period of credit expansion in the global economy to a period of credit rationing. Credit rationing has implications for businesses, it has implications for consumers, and clearly it has implications for asset prices generally. Ask anyone that's tried to get a mortgage on an investment property in Australia this year, and they'll tell you the effects of credit rationing is having on that particular part of asset markets. What do the effects of this look like on a cumulative basis? You see there the actual purchases on a sort of 3-month basis. But if we look at the total effects of that, you can see the scale of what's gone on over the last decade. This is the cumulative effect of those purchase programs on balance sheets by the Federal Reserve, the Bank of England, the ECB, and the BOJ. So it's, what we're looking at here is unprecedented in scale. $16 trillion of government paper now sitting on central bank balance sheets, almost 20% of global GDP. There is a recent generation of investors that have known nothing other than central bank support in terms of financial markets. And our question today, really, and the one that we confront in 2018 and beyond, is what the world looks like as that support mechanism is slowly withdrawn. So it's critical that I think anyone allocating capital to a manager or indeed another stock or an investment property, what have you, needs to think about the effects of this credit rationing environment that we've moved into. And it's very clear to us, at least, that it explains the pickup in volatility we've seen in 2018. With the exception of a few large cap, well-known companies, markets have largely stopped going up. And we think it ties directly into this process of credit rationing that's begun. But at Antipodes, we're primarily concerned with industries and companies, and we'll give you a snapshot of how we go about that. And we'll give you an example of something that's in the portfolio today. Here's one of the key tools that we use within our team. It's our global sector heat map. You can see we have the world arranged by region and sector on the different axes here. There's a lot of information on the chart. Probably the key thing to focus on is the color coding. The shades of yellow, orange, and red are parts of the global market that are expensive relative to their history, and the various shades of blue are parts of the global market that are cheap relative to their history. So just to pick a few out, you can see the consumer staples sector in the middle of the diagram there. The shades of dark red indicate that part of the global investing landscape has become very expensive. I think a direct beneficiary of the lust for low volatility assets has meant that parts of that sector have become critically unstable in terms of valuation. So we would be generally cautious on those types of companies. Similarly, you can see parts of the technology landscape have also become quite expensive in recent years. On the other side of the equation, you can see financials, communications, and domestic cyclicals have become very cheap and remain cheap, in fact, for a number of years now. This is an area of interest for us. We've focused a reasonable amount of our time over the last couple of years trying to uncover what we think are interesting opportunities in those parts of the global universe. One of the examples that we've been talking about comes from the communication sector. It's a company called KT Corporation. I used to describe it as the Telstra of Korea. It's probably not the best reference these days. However, it is the former state-owned monopoly telecom provider in Korea. There's a couple of things that make us very interested in this type of asset. And I'll draw your attention to the bar chart on the bottom right-hand side of the diagram. What it shows you is the degree to which various parts of the world have built their fibre networks to the home. And you can see Australia and the US around 15 to 20%. The OECD average indeed is close to about 20%. If you look at Korea, that country has already basically built out its fibre program. So fibre penetration to the household in Korea is close to 90%. And if you think about what that means, it means that KT today already have an NBN contained within it. It's the ambition of NBN to get to those levels one day. There's a spending program amounting to some $60 billion to try and make that happen. But in KT today, you have an NBN embedded already. That means that most of the capital, important capital, has already been sunk, and the business is now in a position to start harvesting that investment. So that's one element that we like. We have an NBN contained within KT. The other element is the real estate portfolio. A virtue of the history of this company is that they have this reasonably large real estate portfolio that's been carved out into a separate legal entity. It generates annual income of about $700 million a year, so the assets are real, they're income producing. We think on a mark-to-market basis, that portfolio is worth somewhere between $6 to $8 billion US dollars. So again, a very tasty asset inside of KT. Then the ultimate question, of course, is what do you pay for KT? You've got the NBN optionality, you've got the real estate portfolio that I mentioned. Today the entire company is available to purchase for $6 billion US dollars. So in a country with 45 million people, with an NBN embedded, a $7 to $8 billion real estate portfolio, we think that is a pretty attractive risk-reward opportunity. KT's dividend can go up. The payout ratio is relatively low. There's a very high correlation across the region between payout ratios and valuations of telecoms. That cash flow that comes out of their fixed line network can be harvested to be returned to shareholders, and the dividend can go up over the next couple of years. All told, we think this business could be worth 2 to 3 times the current levels. That would bring it up to a regional peer group valuation multiple, which is more befitting of this asset. So KT is an interesting one for us, top 10 position in the portfolio. Continue to be very interested in their prospects. We're a long-short manager, so let's talk about some of the short clusters in the portfolio. You've heard a lot of commentary today around the global situation. I think some of that's reflected in the way we're thinking about the short book. Leveraged cyclical businesses, so these are companies that have taken full advantage of the low and falling rate environment that we've all enjoyed over the last number of years, to the point, in our view, where balance sheet leverage is at critically unstable levels. And these businesses are ultimately very vulnerable to any shift in interest rates or credit tightening. We have a cluster of shorts in that space. Overhyped disruptors. Disruption has become probably the most overused word in investing in the last few years. A lot of disruption amounts to just good old-fashioned competition. So we've sought to get short exposure to businesses we think are pretenders rather than innovators. And then the final one is the low volatility bond proxy trade. We've got several examples of that. It's across different sectors and different geographies. There's been no bigger beneficiary of low volatility and falling rates than Australian East Coast real estate. We have some exposure to that via the banks here in Australia, but we also have exposure to things like Nordic real estate, US industrials, where we believe that the effects of low rates have flowed through to those types of businesses. I'll just leave you with a final chart, which is a snapshot of our performance over the past 3 years. Quite a few numbers here. I'll just draw your eye to the capture ratios. That signifies how much of the market movements our funds are capturing in up and down months. And you can see the down market capture in our 2 global funds. Our global long-short fund is only 50%. So we're capturing only 50% of market downside when markets fall, and almost 100% of upside when markets rise. We think in an environment of credit rationing, where volatility is going up, we have the tools available to us to manage that environment, and that should hold us in good stead as we look forward to the next 5 years. So thank you very much for your time. I'll hand it back to Matt Dell, and enjoy the rest of your day.